The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Oh my goodness me, we've got a show for you today. We're also going to start off with a real good ding-dong about inflation, because I'm just not as convinced as some of you are that inflation is on the right direction. Anyway, Karen and I will talk through this in a few moments' time. Would you like your headlines? I'll get to them now. Wall Street rallies to a trio of fresh highs. Yes, this as US inflation, well, apparently, and I say apparently, comes in softer than expected. Core prices seeing their smallest gain in 3 years. Meanwhile, Warren Buffett's Berkshire Hathaway reveals insurer Chubb as its multi-billion-dollar mystery bet in its latest 13F filing, sending shares spiking in extended trade.
Israeli Prime Minister Benjamin Netanyahu stands firm on a Rafah offensive despite tensions with the US, telling CNBC they will push on regardless.
Yes, we do have a disagreement on Gaza, on Rafah, but we have to do what we have to do, and sometimes you just have to do what is required to ensure your survival in your future.
China rolls out the red carpet for Russian President Vladimir Putin as both countries seek to bolster strategic ties.
And Siemens revenue flatlines in the second quarter and orders see a 13% drop as the company confirms its outlook. We're going to hear from the CEO, Roland Busch, 7:45 Central European Time. Let's go through it. Equities got excited. Bond markets got excited. The scribes got excited. I don't even know if Karen's excited. Are you excited?
I'm excited.
All right, Karen got excited. And guess what? I'm such a curmudgeon. I didn't. But there you go. Let's just go with the numbers.
Shock horror.
Yeah. Well, it kind of makes the show,
that's the
doesn't
breaking
it?
news,
If I
isn't it?
agreed
Shock
with everything
horror.
everyone said, I think we'd be mildly duller world. But anyway, let's go through the numbers and then we'll have a little think. US inflation eased. No, it didn't. It didn't. The pace of inflation, US inflation didn't, well, US inflation eased in April, breaking a streak of hotter than expected readings. I agree with that bit. Providing some welcome news to the Fed and consumers alike. Really? Okay. Wall Street rallied to fresh records after consumer prices rose by 0.3% on a monthly basis. That is less than, less than some forecasts. See, look at me. I'm questioning even my production team who's just pointing out the facts. It was the lowest level since January. There you go. That's right. On an annual basis, CPI increased by 3.4%, while core CPI by 3.6%. That is the smallest gain since April 2021. Now, shelter and energy prices were the biggest drivers of April's inflation report. Shelter rose by 5.5% on the year, whilst energy and food increased by 2.6% and 2.2% respectively. So these are all the factors. Now guess which one I'm going to focus on a little bit later. Can you guess? I'll come to that in a few moments' time. Karen, talk about the market.
Well, let me get to some bigger numbers. It was on the stock market, records across the board. Intraday on the finish, you saw it on the three major boards this time, not just the NASDAQ in record territory, but the Dow, the S&P 500 also closing that gap. And in terms of what it represents, for the likes of the Dow, this is the 18th record close for this year, the 23rd record close for the S&P 500 for 2024, and the 8th record close for the year for the NASDAQ. So we've inked records before, back in that territory again. Big moving names, no surprise. NVIDIA, one of the big drivers for both the S&P 500 and for the NASDAQ, and for the likes of the Dow, it was Salesforce. So an element of tech coming back into the mix as we talk about potentially the cost of credit coming down in the near future. That was an area that was, again, another trigger for some of the Magnificent Seven stocks and further beyond that in the tech universe. to the dollar trade, and we have seen some movement in the dollar. Don't forget, dollar has been king for a while now, thanks to this diversification we're expected to see in monetary policy. But euro sterling back on the front foot this morning. You've got to say 108.84 on euro dollar. Sterling trades 126.87. Dollar also perched lower versus the Japanese yen. That's not a phrase we've been able to use very often. It's required, we think, a little bit of intervention in the market by the Japanese to try and get that type of equation. This time round, it may have just been the data. Dollar yen rates, you can see dropping 153.85, roughly what they trade this morning, down just over 0.6%. To the Treasury market, it is a feature that we've seen this drop in yields. We've had a rally in bonds, a rally in stocks. So across the board, both have been rallying. We're 4.71 at the short end. At the 10-year, we're 4.32. So genuine movement we're seeing there. Now, the cooler than expected inflation print boosted bets that the Fed will launch rate cuts in coming months, with data from the CME's FedWatch tool showing a 54% chance of a cut at September's meeting. So I'll pick up on some of the positive, and this is a market view, I think, general consensus that, look, it's Goldilocks when it comes to some of the data. The market has been waiting patiently for some of the evidence to come through. Even before we had the CPI print, we had the market saying, it's coming through at some point. We're perched just off records, had the confirmation, we got through it. So I think for a lot of the market participants, this is just confirmation that we're not reigniting inflation, which was the dreaded scenario taking place. We're back in previous decades. We're not getting that according to the market. In fact, soft landing is still in play. So I think for the markets, they're reading the data as certainly a good sign.
Yeah, except there was no sign, was there? And it's not Goldilocks and the market's wrong. Look, why don't I do this? Because look, I'm here to do this, just to add the element of doubt. There was nothing to say in this data that things are moving to the kind of level where the Fed can cut rates. Okay, let's just get that point out there as well. We are still stubbornly stuck at levels which are stunningly higher than the 2% target. They need to see a firm trajectory down. And actually, if you look at the core piece of data there, when I showed people, can I wander over, Rod? Yeah. I don't want to lose the director. I get in trouble for losing. Look at this. Shelter was up still 5.5%. But this is the key piece of data I want to strip out for you guys, because I did some work for you guys, courtesy of all the lovely correspondence I got in there as well. Core services ex housing, the index rose by 0.4% a month. Now, I'm very willing to admit that was lower than the 0.7 in March. Yes, it's moving in the right direction. But on a 12-month change, so the smoothed out 12-month picture, it rose to 4.9% from 4.8%. My point being is not that the general direction, I'm not arguing with the premise that the general direction of travel for most of the data, excluding that inconvenient piece number there, most of it is moving in the right direction, but it is such a glacial pace that no one can say that inflation is beaten. No one can say that inflation is tamed, and no one can say on the back of these numbers that rates should be lower.
I'm going to call you impatient because I think there was a pendulum.
Impatient? I think I'm the most patient man out there.
There was a pendulum that the market was looking at this week. The fact that we're almost pushing the scenario of rate hikes off the table has been enough to move markets. We saw it early in the week with Jay Powell.
Is that where we've come to?
Exactly.
That so it's not about hikes.
Well,
this is a market
the reaction from Jay Powell early in the week.
At the start of this year, I'll let you come. But this market wanted 150 basis points of cuts. And now we're rallying to record levels because we're not going to get hikes?
Well, I think that lingering view that we could reignite inflation has been an ever-present fear. And the market has been a little bit cautious about that happening. But when Jay Powell said, look, the rate cuts are coming. It's just going to take longer than expected. We saw the market take off, not responding to some of the negative data, but in fact leaning into Powell. And again, a bit more of that confirmation yesterday. So we're not talking about a rapid U-turn saying, oh, the rate cuts are here now, let's bring them forward thanks to the data. That wasn't the change we got. It was much more nuanced than that. It was we're pushing out that scenario of a rate hike. So I think the market reaction, more nuanced, not the pendulum shift that you're talking about. I think there were genuine elements to look at yesterday in the data. For instance, we had flat retail numbers, so suggesting the high street behaviours are changing. The Fed's been looking for that. The wage price spiral isn't triggering more spending again on the high street. You had two major brands responding yesterday as well. McDonald's coming out with this ridiculous price $5 meal bundle where you can get a McDouble, a McChicken sandwich, or one of the two, a soft drink,
no deflation of the calories
chicken
in that meal,
McNuggets, all small fries as well for $5. So telling you about this huge bundle because it's struggling to get consumers through the door. Coca-Cola thought to be behind that, supporting the promotion as well. So two major brands telling you that they're having to get more promotional because consumer behavior has changed. That's exactly what the Fed is looking for.
There is nothing nuanced or subtle about what the market is making of this as well. It was buying the market aggressively, praying for rate cuts as well. All I'm saying is the data at the moment is not moving quickly enough for any rate cuts this year. It may change, but when you've got a 3 handle on the headline figures, a 3 handle on the core figures, a 5 handle on shelter, a 5 handle on services, a 5 or a 6 handle on wages, you ain't going to get rate cuts.
I think if you look at the market behavior yesterday, it was in the tech sphere. You saw a lot of that activity concentrated there. So the forward cost of credit over the next 12, 18 months, I think that has been weighed up by the market. And a lot of people wanting to get back into tech. So I think you saw an element of that. This is the AI story playing out once the market's a bit more comfortable around the rate scenario story.
You know, we have 9 guests plus correspondents on this show. I better try and find some time for some of them. So I better move on. But I love this conversation. And if you disagree with me, I don't mind that. I just want you to think about what's going on. That's all we're trying to do on this show. Right, our US colleagues will sit down with the Richmond Fed President Tom Barkin later today. That's going to be great. I'm going to watch that one. Exclusive, that is. 1600 Central European Time. And for more on April's inflation report, check out CNBC.com.
Israeli Prime Minister Benjamin Netanyahu has told CNBC he and US President Joe Biden are at odds over Israel's military operation in Rafah, but vowed to push ahead regardless. This on the back of reports the Biden administration will send a new package of more than $1 billion in arms and munitions to Israel amid congressional pressure, although Netanyahu declined to confirm those reports. Speaking to Sarah Eisen in Jerusalem, Netanyahu also ruled out plans for a post-war 2-state solution, with the Palestinian territories saying such a move would play into Hamas's hands. The Israeli leader told CNBC he hoped an arms agreement with the US could be reached soon.
I appreciate the help we receive from the United States from the beginning of the war. President Biden came here. He sent also these battle carrier groups, and we got weapons. Yes, we do have a disagreement on Gaza, on Rafah. But we have to do what we have to do. And, you know, sometimes you just have to do what is required to ensure your survival in your future. We cannot continue into the future by having Hamas retake Gaza. It's not only would be a tremendous victory for Hamas, it would be a tremendous victory for the Iran terror axis, because Iran is trying to envelop us with a noose of death, of which Hamas is one component. And that victory is a victory against Iran. It's a victory for the moderate Arab states who are not openly, but who understand that their future is involved also with our victory against Hamas. So we are doing what we have to do, and I hope we can see eye to eye with the United States. We're talking to them, but ultimately we do what we have to do to protect the life of our nation and to prevent such savageries from being repeated again and again and again.
Can you talk about a 2-state solution after you remove Hamas?
Look, the 2-state solution that people talk about is basically would be the greatest reward for the terrorists that you can imagine. 80% of Palestinians in Gaza and in Judea Samaria, in the West Bank, support the savagery. Giving them a state would do 2 things. One, it would be a tremendous reward, a historic precedent of giving those people who committed the worst massacre against the Jewish people since the Holocaust on a single day, giving them a prize. And second, it would be a state that would be immediately taken over by Hamas and Iran, and it wouldn't advance the purposes of peace. It would just be a launching ground for a future war against Israel. I think that that's not in the works, and most Israelis by now, a huge number, would say, don't do that.
CNBC's Sarah Eisen there speaking to Netanyahu. Well, Russian President Vladimir Putin has met with Chinese President Xi Jinping in Beijing as the two nations look to bolster strategic ties. The visit is Putin's first foreign trip since being sworn in for a 5th term in office.
The Dutch populist leader Geert Wilders said an agreement has been reached, this with negotiators, mind you, rather than the parties, on what is set to be the Netherlands' most right-wing government in decades, following months of negotiations. A decision, again, is yet to be made on the next Prime Minister. There's lots that can go wrong, but it's a position that Wilders has said he will forfeit to help secure a deal. Lots of names in the frame there. Slovakia's Prime Minister Robert Fico is also a very controversial figure, but he's no longer in a life-threatening condition after an apparent assassination attempt. The country's Deputy Prime Minister has said. Now, Fico was shot at 5 times when leaving a government meeting yesterday, initially leaving him in a critical condition. Sylvia, what do we know? For a start, Mr. Fico is a very divisive character as well. His party has been trying to say this is politically motivated, but do we actually know that yet?
We don't know. We have to exert here what we do know and what we don't know. So what we do know is that the Deputy Prime Minister told the BBC shortly, not too long ago, saying that the Prime Minister is no longer in a life-threatening condition. According to the Deputy Prime Minister, he also said that the surgery that the Prime Minister underwent happened was well, and that in the end he believes the Prime Minister will survive this accident. Now, having said that, there's no official comment from the government or the hospital at this stage about the state of the Prime Minister, Robert Fico. So at this stage, what we do know is only the commentary from the Deputy Prime Minister suggesting that the surgery went well. Let's see what will happen and what sort of official comment we'll get in the next couple of hours. What we do know at this stage is that the Prime Minister was walking in a crowd in central Slovakia when he was shot at. We also know that there was an alleged attacker that was detained by the police, but also the detail there is also quite scarce. All in all, though, Robert Fico returned as Prime Minister of Slovakia last year. He is seen as a pro-Russian and to some extent a populist leader as well. And this is actually coming at a time when we're seeing quite a lot of polarization in Slovakian politics, and also at a time when there's been several attacks on politicians. None of this scale, but it does suggest that the polarization is increasing in some parts of Europe. Now, this has actually taken many leaders in the EU by surprise. Slovakia is, of course, a member of the EU as well. We heard from the Hungarian Prime Minister Viktor Orban commenting on what happened, saying that he was deeply shocked by the attack against his friend, and he's praying for his health and hoping for a quick recovery. We also heard from Ursula von der Leyen, the President of the European Commission, also strongly condemning the attack on the Prime Minister, and she also said that her thoughts are with the Prime Minister and his family. And just to show you the extent of how shocking the news have been across Europe, this was also reached in Germany, where the Chancellor Olaf Scholz also shared his concerns and stated that he's also deeply shocked by these developments in Slovakia. Let's see what will happen in the next couple of hours. But of course, at this stage, as we stressed at the beginning, the detail is still quite scarce. However, if we do focus on the commentary from the Deputy Prime Minister, it seems that Roberto Fico is no longer in a life-threatening condition.
Sylvia, thank you very much for bringing us the latest developments there. Now, coming up on the show, US CPI surprises to the downside, sending markets to record highs. We'll discuss what this could mean for the Fed. And orders at Siemens fall in the second quarter, but the company confirms its full-year outlook. The CEO, Roland Busch, has been speaking to Annetta. We'll bring you that interview at 7:45 CET. Plus, we're watching out for half-yearly results from EasyJet. We're going to be joined by the CEO, Johan Lundgren, to discuss the numbers. That is a first on CNBC, coming up at 8 a.m. CET.
Ambition to me is about doing better.
I think ambition creates a pathway.
Best advice I can give to someone starting off a career is don't have a career, have lots of careers, try loads of different things.
Talk to people and put your ambition out there.
I don't feel that I've hit peak ambition because it's a learning journey.
CNBC is where ambition meets opportunity. What does living ambitiously mean to you? Hear it from our CNBC anchors, reporters, and global business leaders on CNBC.com.
Dutch financial services firm Aegon has reported first quarter free cash flow of 14 million euros and said it is on track to achieve its full year guidance. Lard Friese joins us now, the CEO of Aegon. Lard, thank you so much for joining us again. Just wading through your commentary so far today, you're talking about the positive commercial momentum you're witnessing in the United States and Brazilian markets. Just walk us through this catalyst here for the earnings.
Yes, good morning, Karen, and good morning, Stephen. Thanks for having me on the show again. Aegon is starting the year in good spirits. It's a good start of the year. We're seeing continued commercial momentum spilling over from last year into the new year, with life insurance sales in the United States up 5%, which is powered by the increase of our agency network in the US by 13% to 76,000 agents now. And we also see good, strong commercial momentum in the retirement plan business with more than 1.2 billion of net deposits. Brazil is the winner this quarter with a 22% increase in sales. We're seeing strong momentum in the workplace business in the United Kingdom. And also the asset manager is seeing positive flows, 2.6 billion in the global platforms and 2.2 billion in China. And those are reversals to what we have seen in the course of last year, where the asset manager was experiencing a more difficult environment to operate in. There are also weaker spots in the overall picture, which is the retail platform in the UK, which is still suffering from an investor sentiment that is slightly apprehensive in the UK on the retail side. And we're seeing in the life insurance sales in China, we're also seeing lower sales because of, let's say, pricing regulation interventions by the regulator on the entire industry in the context of lower interest rates in China. But overall, I would say good commercial momentum, good start of the year. We have a strong capital position with 2 billion cash in our holding company buffer. Our buyback program of 1.5 billion is well underway. But we are also announcing today, given the strong free cash flows that we're generating and the cash buffer that is building up, an additional 200 million buyback program that we aim to conclude by the end of this year. So overall, we have a strong start of the year.
Lard, can I just pick up on that weakness that you're seeing in the UK consumer? We've seen the UK stock market at a record. The economy here is proving somewhat resilient. Yeah. So why is that sentiment lagging given the macro backdrop here?
There's two things happening in the UK that are driving this, and it's an industry phenomenon. It's not only affecting our company's retail advisory platform business in the UK. It has to do with two things. Number one, of course, inflation has been high. The cost of living conditions in the UK are still subdued, and that is not helping retail investor sentiment. That's number one. And number two, we're seeing less defined benefit to defined contribution transfers happening in the market, which is also a key driver of retail investments. And as that is happening far less, that's also having a mitigating effect on the buoyancy of that environment.
Lord, I just want to ask you about the general premium renewal environment as well. I don't think I've ever seen, certainly this century, a better pricing environment for the insurers across various products as well. Is there a danger the industry is milking those premiums and the better environment a little bit too far and actually is creating problems for itself further down the line? I have concerns that it's actually now showing up in broader inflation indicators as well and creating interest rates scenarios that are higher for longer.
Yes, Steve, I can't really comment on the property and casualty markets as we are largely a life insurance and financial investment products and retirement business. But if you look at interest rates and what has happened, I think the key difference between last year and this year is that the interest rate environment is more stable. It has become the national pastime to gauge if and how many rate cuts and when will those rate cuts happen. That is what we're seeing throughout the year. But by and large, this year, we're seeing more stabilization of interest rates, which is very important for our industry as it makes our products more attractive. And that's good for sales and good for our customers. And it allows us to provide also more optionality in our products. So overall, that stable rate environment that we're seeing now is actually conducive for the entire life insurance industry as a whole, and therefore also for Aegon.
But your industry has seen such stunning revaluations by investors as well on the back of, as I say, a healthy premium renewal environment across all insurance products, including the ones that you wanted to focus on as well. Yeah. Is there a danger that actually this is going to create problems further down the line for coverage?
We don't see that happening at this point in time. We believe that there is a good opportunity and a lot of capacity to ensure that the products and services that we provide to our customers have the options that they need, that are appropriately catering for the needs that they have to plan for their long-term security. And in that sense, we think that the interest rate environment is helping. Of course, inflation not, but inflation is slowly getting better under control. What we have done to navigate clients through this, for instance, is in long-term care premium rate increases that we have seen, is that we're providing them options in coverage so that they can choose themselves whether they wish to maintain premium rates at a lower level in their existing contracts, or but then at the expense of lower coverage, or whether they have different coverage modules to ensure that they can really choose themselves to what extent they want to see those rate increases affecting their personal wallets.
Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to CNBC.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabile Kumete, weekdays on CNBC.